I'm going to walk you through an exercise to talk about how to look at building a portfolio designed to get you the return you need while also minimizing risk. And now in this example, I want you to pretend there's only two kinds of stocks. There are large company stocks and there are small company stocks. McDonald's might be an example of a large company. Denny's is an example of a small company. Let's furthermore suppose that the large stocks have an 8% return and the small stocks 10%. Now, do the large companies have more volatility or the small? It's the small. They're not as established. They tend to be more volatile. Their prices move up and down more. So let's for the moment assume you pick the ones that are less risky, the large companies, and then you have two choices. You can buy large company stocks or you can put your money in the piggy bank. Putting the money in the piggy bank is nice because it has no risk, but it also has zero return. Remember, we talked about your required rate of return, and for the moment, let's assume it's 6%. If you need to get 6% on a portion of your money is going in large company, getting 8, and a portion is going in the piggy bank that's going to get 0. The question then, what portion of your wealth would need to go into those large company stocks? The answer is 75%, with the remaining 25 going into the piggy bank, giving you a mix of 75-25, and over time you would expect it to get you your 6% return. Let's go back to the small companies for a minute though. Remember, the small companies are more volatile, so we're not talking about just buying one small company. That would be too much risk. We're talking instead about buying a basket of thousands of small companies, and as a whole, some of them will do well, others will do poorly, and over time, you would expect their prices to move a lot. That basket's going to move up and down more than a basket of large companies would. But you would also expect that you'll get higher returns from that basket of small companies. And so if you bought the small companies and that was one option, and the piggy bank was your other option, well, in order to get to your 6% required rate of return, you would put 60% in small companies and 40% in the piggy bank. Stepping back, let's say you have $1 million and it goes in that 60-40 portfolio. You put $600,000 in small company stocks, $400,000 in the bank. Furthermore, suppose you need $40,000 a year in income from the portfolio. Divide $400,000 by $40,000 and you get 10. 10 is the number of years of spending you have in cash before you have to worry about what the stock market's doing. The bottom line is that by having more diversification within your stocks, you might be able to build a portfolio that's safer overall and lets you sleep at night.